Good afternoon. I put together a presentation here for you that should help you analyzing the Dell case. And this is all going to be about accounting, but I'm going to keep it very simple. Start off here with a quote from Warren Buffett. He says the importance of knowing accounting cannot be underestimated because it's the language of business. And if you don't know it, it's like being in a foreign country without knowing the language. Well, let's take a look at this and see if we can help you understand the language. We use three different statements, only two of which we're going to look at today. One is the income statement and the other is the balance sheet. And you can look at this in terms of the moving picture being the income statement, which is constantly recording data as you go from the beginning of a period all the way to the end. And typically we're looking at that as being a full year. By contrast, the balance sheet is a point in time snapshot, and it's where things are just at a moment in time. Of course, the values will change again one moment later, but we want to be able to take that snapshot. As a result, you'll find that when you get an income statement, it will say for the period ending and then have the date, because it's covering a moving picture or a movement over time. Whereas the balance sheet will show as of and show the specific date that's involved, because it is a snapshot. Finally, a income statement will bear temporary accounts versus permanent accounts in the balance sheet. The income statement is temporary from the perspective that we accumulate all of the sales and costs of sales over the course of a year, for example. And then at the end of that year, we zero everything out and begin all over again in the next year. Therefore, the values in there are temporary for each period. By contrast, the values in the balance sheet will be carried forward from 1 second to the next, from December 31st at 11:59:59 to January 1, 1 second after midnight. The values will be the same. While the values will change in and out, up and down during the course of the year, they will always be a value that's carried forward, even if that value happens to be at a point in time 0. So let's take a look at the two statements. And this is the same material that I told you in the information tab that you can pull down that shows some business arithmetic. It's exactly the same income statement and exactly the same balance sheet. The income statement is really a subset of the balance sheet because it shows all the transactions that will positively affect one item on the balance sheet, and that is retained earnings, and all of the things that will diminish that same value, which is, again, the reduction of retained earnings. So at the end of the period, and this is as detailed as we're going to get, we will take the profit, in this case $39,000, and transfer it to the balance sheet in the area called current period earnings, which is in the bottom right-hand corner of the balance sheet. At that point, the income statement is in, because it is temporary, it goes back to 0 and the accumulation begins again. So here is the income statement, and a couple things we're going to look at. We're going to look at sales, and the second item, cost of goods sold. And that's all that I will show you during the rest of this presentation, just those first two items. On the balance sheet, we're going to look at, over on the left-hand side, the first entry, cash. The second entry, accounts receivable. The third, inventory. And then going over to the right-hand side, we're going to look at the first entry, which is accounts payable. That's all we're going to examine in the remainder of this presentation. And the characteristic of all of the ones I mentioned, cash, receivables, inventory, and payables, is that they are all called current, either current and the title up on the left-hand side is assets, or on the right-hand side, liabilities. Anything that's current has the characteristic of flowing through the cash account at some time during the next 12 months. So cash becomes cash within the immediately. Accounts receivable will typically be collected every 30, maybe 40 days. That is, they'll flow through the cash account. Inventory will be sold and converted into cash as people pay for what they buy. And then on the other side of the ledger, among the outside owners, accounts payable are bills that we need to pay, and those are paid normally within 30 to 45 days. Those things, because they're constantly moving, are things that we have to watch very closely. It also becomes the biggest place that we can let our cash get out of control. That ultimately is the end of the day thing, is we've got to maintain control over our cash. So I like to look at the balance sheet as consisting of a series of tools that contains the permanent accounts. And I always refer to them when I'm talking about them as categories. And by contrast, on the income statement, I will refer to anything there as an entry. But on the balance sheet, it always is a category. Now, it lists all the categories. It gives you the owners. It lists both the categories and the owners of those tools. Now, what we need to know and be able to control and understand is how many dollars in cash must be invested by the owners in order to buy those tools used to run the business. We need to know that. So the value of the tools will exactly equal the value of the owner's claims. And that's, you can't have something that is owned that doesn't have an owner, and you can't have an owner unless they have some tool that they lay claim to. So what we're going to do is be able to track those two categories. The tools that are used are also called, in accounting, they're called assets. And the owners are called either liability holders, creditors, banks, or shareholders. And that the sum of the assets or tools used will exactly equal the sum of all of the claims of creditors, banks, and ourselves as shareholders. Now, this is maybe the most important slide in here because it will tell you exactly how much you have to invest as an owner in order to make the company function in each of the categories that we have on the balance sheet. And this is determined by the amount that you have to invest is determined by your business policy, by industry practice, and by the size of your business. Now, your business policy is what you state it to be. We're going to look at the 4 items that I indicated to you before the end of this presentation. The industry practice may be either looser or tighter than your business policy. And generally, what you have to do is to follow the industry practice rather than your business policy. For example, you may say, I'm going to sell all of my merchandise on a 30-day basis that I expect to be paid in 30 days. If the industry suddenly decides, in order to sell more stuff, that they're going to go on the basis of 60-day terms, we'll probably have to follow and offer 60-day terms as well, because the terms are part of the price and people are price sensitive in anything that they buy. So we need to know what our policy is and know what the industry practice is. And then based on the size of our business, along with the business policy or industry practice, we can determine how many dollars we need to invest in each category. And this is really the key idea of this whole presentation. Now, what are the most common tools the management invests in? Well, it's the same things that we've talked about thus far. It's investment in cash. You have to have some money in your hand in order to be able to carry a tune. You have to have accounts receivable. This is money that we invest for presumably about 30 days, but we must have accounts receivable in our business. We have to invest in inventories, and depending upon the commodity that we use or the product we're making, that investment may run the equivalent of 60 days usage or 120 days usage, or in some cases as much as a year on highly specialized inventory. Finally, we invest in plant and equipment, and that's not our concern for the conversation today. So all of the items there with the red line next to them are current items. That is, they all become cash within the course of, typically within the course of a single year. We got a real problem if they don't turn into cash within a year. Plant and equipment tend to be long-term, and they may take as long as 30, even as long as 50 years to turn into cash for us. But in every case, each of these categories will turn into cash sometime in the corporate life. These are, from our perspective today, these are just paper entries, but they really represent something that is extremely tangible. Now, let's take a look at these individually. The first tool that we use is cash. And the function of cash is there's only one function for cash, and that's to lubricate the organization, to keep the wheels of commerce turning over. Now, I have there on the left-hand side of the slide a thing called an oil reservoir. And if you have a piece of equipment that has turning parts in it, you have to keep it lubricated. And in a large factory, you may find these oil reservoirs on all of the bearings on the machinery in the factory. And you fill up that container to the red line with oil, and the oil drips out through that relief tube onto the bearing at a controlled rate. And your job is always to keep enough oil in there to prevent it from running dry. If the oil reservoir runs dry, the bearing stops and you have a big mess. Correspondingly, if you fill it to, the big mess you'll have is you won't be able to run your factory. By contrast, if you fill it up too full, you get a big mess of a different kind. It flows out and runs onto the ground. And it's the same thing with cash. If you run out of cash, you're out of business. On the other hand, if you get too much cash, you'll find in a subsequent lecture when we talk about it, that you're vulnerable, that people can take your company over, and certainly people will judge you as being an ineffective user of your resources. If you got extra cash, all it shows is that you're just not managing effectively. Now, how much cash do you need in your company? Well, and how are we going to measure and track it? The easiest thing to do is to use days cash usage. And we can derive that as follows. And so this is something that you'll want to be able to come back and look at, or to write down right now as we're going through it. But you can take annual sales and divide by 360. Now you might ask the question, why do I use 360 instead of 365? Well, the arithmetic is easier for one thing, but equally important, we frequently will take our financial statements and look at a full year, or look at a quarter, which is 90 days, or at a month, which we consider to be 30. So 12 times 30 is 360, 4 times 90 is 360, and 360 times 1 is 360. So it's more convenient because what we're looking at is getting answers that give us direction and not looking for mathematical precision. So if we take annual sales and divide by 360, this will give us our daily cash usage. Now, how many days cash usage on hand will make you feel comfortable? And that's something that's very personal. I can generally work with a very small amount of cash because I've learned over time that I always have cash coming in, and I can kind of control most of the things I use cash for. But you'll have a different perspective on that than I will, and that's going to determine how you'll run your business. Well, how many days cash do we have on hand, irrespective of how many we want? What you do is you take your cash from the balance sheet, take the daily cash usage, which we developed on the previous slide, divide the cash from the balance sheet by the daily cash usage, and this tells us how many days cash usage you have on hand. Now you can compare this to the previous slide, and are you still comfortable once you've calculated your actual cash balance versus that balance that you really would feel comfortable having? The second item is accounts receivable. And you may recognize Wimpy from the old Popeye cartoon character. And Wimpy always would tell you, I would gladly pay you on Tuesday for a hamburger today. And that's exactly what our customers are telling us. And so accounts receivable is our investment in the customer to make the sales happen, because they want to have terms as they buy material from you. So the amount of cash invested to finance your credit sales, how much will it take? How much will we have to invest? Well, and how are you going to measure the health of your accounts receivable investment? The way you can do this is to figure out how many days on average it takes to collect your invoices. So how do you calculate this? Well, you take your total annual sales, divide by 360, and that'll give you your daily sales. Take the accounts receivable from the balance sheet, divide that accounts receivable by the daily sales. This will tell you how many days currently it takes you to collect money from your customer. So now we come back to those three items that I mentioned at the beginning, your policy and the industry practice. The third item, of course, is the size of your business. How many days is your AR policy? And you need to have a policy for this. I typically would be selling merchandise on a 30-day basis. How many days does the industry practice at? Well, you've got to determine that by watching what your competitors do. Use the larger of those two as your target. Then compare your collection days with the previous slide. Are you collecting as fast as you should? So if you've got a 30-day policy or say 35-day policy, and in the previous slide, you calculated that your receivables at this point in time are 42 days, then you're not collecting as fast as you should. On the other hand, if they were at 32 days and your policy was 30 to 35, you would be right where you want to be. Now, how much do you expect to invest prospectively in accounts receivable? Not what's in there today, but what would we see 30 days, 60 days, or 90 days? Then what we do is we take our expected daily sales, not the current daily sales, but the expected daily sales, and take the larger of either your accounts receivable policy or industry practice days and use that. And multiply the number that you select, either your policy or the industry practice, by your expected daily sales. And this will be the amount of out-of-pocket you'll expect to invest in accounts receivable. So if we say, take our current sale level and expect to grow by 20% over the next year, we can go out and figure out what our sales will be at the end of that year to get a 20% increase and use that as the basis for calculating how much out of pocket we have to invest in accounts receivable. Just following the instructions on this slide. The third thing that we have to look at is inventories. And they're a little more difficult to work with, but the principle is the same. Inventory, rather than relating to sales, relates to cost of goods sold, because that is the merchandise that you purchased, processed, and then sold. So you take the cost of goods sold from your income statement, divide that by 360, and this will give you your daily inventory usage. Take that inventory value from the balance sheet and divide it by your daily inventory usage number, and this will tell you how many days usage you have on hand. And whether you're happy with that or not is going to be in part determined by what kind of service level you feel you must give to your customers. Can you afford to have out of stock? Can you afford to keep extra merchandise on hand just to be carrying it and be a nice guy? So what we can do is look at what our policy is for days inventory on hand. What is the industry practice for the days inventory on hand, and take the larger number, multiply your daily inventory usage by this number, the one you select, and this will tell you the amount of out of cash or out of pocket, amount of cash out of pocket that you need to invest in inventory to run your business as you're currently running it. And now the question is, are you satisfied? Does this compare well with your competitors? Does it compare well with your pocketbook? And does it compare well with what your customers state as their needs? The last thing then that we're going to look at is accounts payable. In this case, this is in money that our supplier invests in us to help us make the buy. They provide, what they do is they provide the product and at the same time a loan, because they don't expect to be paid cash on the barrelhead. They provide the product and give you a loan so they can make the deal. Now, how long can you delay that payment? In other words, how many days are you going to take before you must pay? Now, accounts payable, just like accounts receivable, or I'm sorry, just like inventory, relates to cost of goods sold. So you can take the cost of goods sold from the income statement, divide it by 360. This will give you your daily purchases. Take your accounts payable from the balance sheet and divide by your daily purchases. And this will tell you the number of days your supplier is financing you. Now, that may or may not be satisfactory. You may want to have more dating, is what they call it, or more time to pay your bill. So what is your policy for days payable on hand? And every company should have that policy, and it will probably not be the same as what your vendor says is his policy, because you can generally get a few more days before you'll get your vendors upset with you. So what is the industry practice for days payable on hand? Maybe that your vendor wants to give you 30 days, but on average, people are paying in 40. You can push toward that 40 days. But if the industry is really pressing hard and getting paid quickly, then you may have a situation where you're not going to get as much financing from your vendor. And what you want to do is to take in this case, rather than the larger of the two numbers, the smaller, because this is what is going to be ultimately the amount of time you're going to have in order to pay your bills. So multiply your daily purchases by this number. And this is the amount of free financing you can expect to get from your vendors. And of course, we want to get this interest-free loan. It's the best deal you got. So you want to push that as hard as you can. So as sales increase, you purchase more, and the total amount of the interest-free loan from your creditors increases, even though the credit terms may remain the same. So how much financing can be done for free from your creditors? Well, that's something that you've got to work out, and it becomes very important for completing the transaction. So there we are. And this is what I wanted to show you. And I think if you go back through these slides, and this, I'll put the slides out as well as this video, you'll find that you can get some good insight into what Dell has done and what they're attempting to do to maximize their cash on hand, or maximize the cash that they squeeze out of their business. And that's really exactly what you want to do, is you want to, the more cash you can take out of the business without harming the business, the lower your investment has to be for a given level of sales. Dell was in a situation where their growth was so rapid that they were having to invest more money in to the 4 items that we talked about, in cash, receivables, and inventory, less what they got from their vendors in terms of financing. It was growing so rapidly they couldn't generate enough cash to continue to grow. And so that's the situation that you are going to be looking at when you do the Dell case. So I'm going to sign off at this point and wish you well with this, and we'll talk about it at our next face-to-face meeting.